Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the money world. And today we're diving into Richtech Robotics' latest quarterly report. And let me tell you, things are getting interesting. We've got some big moves, some big numbers, and a whole lot of robot talk. So buckle up, because this report could tell us if Richtech is building the future or just building a really expensive pile of metal. And before we get started, if you like decoding the strategies behind the companies that shape our world, make sure you're subscribed to Corporate Decoder. We also have a thriving community over on Discord where we break down these reports even further, so join us there. The link is in the description below. Scroll steht about kannst, Tickets validated, balance sheet, scroll claw right. Let's jump right into the numbers, starting with the balance sheet, the company's financial snapshot. As of June 30, 2025, Richtech had cash and cash equivalents of over $32 million. That's a massive jump from around $14.5 million at the end of the previous fiscal year. Where did all that cash come from, you ask? Well, the company notes that this was a result of issuing a lot more stock. They also had short-term investments growing from about $15 million to over to the end of the previous fiscal year. Where did all that cash come from, you ask? Well, the company notes that this was a result of issuing a lot more stock. They also had short-term investments growing from about 15 million to over to 5 million. This suggests they're buying more robots, more machinery, and more assets to support their growing business. On the other side of the coin, their total liabilities are pretty low, sitting at just about $1.4 million. That's a good sign, meaning they don't owe a whole lot of money compared to what they own. And then their stockholders' equity. This is where the real story of their financing efforts lies. Additional paid-in capital jumped from around $49 million to over $126 million. That's a huge increase, and it directly correlates with all that new stock they've been selling to raise money. Now let's look at how the company is actually performing in terms of making money or losing it. The statement of operations tells us that story. For the first 9 months of 2025, their total revenue was about $3.6 million. That's a slight decrease from the same period in 2024 when they brought in $3.7 million. This might sound concerning, but the company explains this is part of a strategy shift. They're moving towards a robots as a service or RATS model, which means they make less money up front on selling robots but gain more steady income over time through service contracts. Interestingly, their cost of revenue significantly decreased. For the 9 months, it dropped from $1.4 million to just $878,000. This is a big deal. The company explains that when they lease robots instead of selling them outright, they don't record the full cost of the robot as an expense immediately. Instead, they depreciate it over time, which lowers their immediate cost of revenue. This explains the positive trend here. But here's where things get a little hairy. General and administrative expenses went through the roof. For the 9-month period, they soared from $3.7 million to a staggering $13.8 million. That's an increase of over $10 million. The company blames this on hiring more people, growing their legal teams, and moving to a new office. While growth is good, this massive jump in overhead needs careful watching. As a result of these higher administrative costs, even with lower cost of revenue, their loss from operations significantly widened. For the 9 months ended June 30, 2025, the company lost $13.3 million compared to about $4.1 million in the same period of 2020 million dollars compared to about $4.1 million in the same period of 2020 million dollars compared to about $4.1 million in the same period of 2024. This is a significant increase in their operational losses. On a brighter note, investment income jumped from $0 to $1.1 million for the 9 months. This is because all that cash they raised from selling stock is being put to work in short-term investments. Let's see how their cash is actually moving around with the cash flow statement. For the first 9 months of 2025, they used over $11 million in operating activities. This is way more than the $2.1 million they used in the same period of 2024. Again, the bigger loss is the main culprit here. Investing activities also saw a major outflow. They spent over $41 million on investing activities, mostly on short-term investments and equipment. This shows they are actively deploying their capital. Financing activities, however, brought in a lot of cash. Over $71 million came in from issuing stock and warrants. This is a huge difference from the roughly $10.7 million they brought in during the same period. In 2024, this confirms the massive fundraising efforts we saw earlier. Looking at the quarterly breakdown for the 3 months ended June 30, 2025, revenue dropped to $1.1 million from $1.4 million in the previous year. This makes sense given their RAS strategy, but the surge in general and administrative expenses is a key point to watch as it's eating into any potential profitability. It's worth noting that they recorded an income tax expense of $317,000 in the 3-month period of 2024, but recorded very little tax expense in 2025. This is likely due to their ongoing net losses, which can create deferred tax assets. And get this, just after the quarter ended on August 11, 2025, they raised another $22.5 million through their stock offering program. This shows they are continuing to tap the capital markets to fund their operations and growth. Scroll key business highlights for the third quarter. In terms of business actualities, they made a big move in July 2025, joining the NVIDIA Connect program. This means they'll be working with NVIDIA's technology, which could be great for developing their robots. They also bought a new 20,000 square foot property for $4.1 million to expand their assembly and manufacturing operations. That's a solid step towards bringing more production in-house. On June 27, 2025, they were added to the UPSA Russell 2000 and Russell 3000 indexes, which is a good sign that they are becoming a more recognized player in the market. They're really pushing this RAS model. They signed a deal with a large car retailer group and started installing their robots in 5 dealerships. They're also looking at using their robots in factories for material transport. This diversification is smart and shows they're actively seeking new markets for their robots. They also attended the National Restaurant Association show to find new customers. Plus, their subsidiary in China signed a significant deal worth over $4 million for products and services. This international expansion is also a positive development. Now let's talk about the notes to the financial statements. These give us the nitty-gritty details. For instance, under the summary of significant accounting policies, we see they're an emerging growth company. This means they can delay adopting new accounting rules, which might make their financials look different compared to bigger, more established companies. They explain their revenue recognition policy, which is important for understanding how they count their earnings, and they note that their allowance for credit losses, which is basically a buffer for money they might not collect from customers, is about $86,000. This indicates they are managing growth company. This means they can delay adopting new accounting rules, which might make their financials look different compared to bigger, more established companies. They explain their revenue recognition policy, which is important for understanding how they count their earnings, and they note that their allowance for credit losses, which is basically a buffer for money they might not collect from customers, is about $86,000. Let's look again at that earnings per share. For the 9 months ended June 30, 2025, their net loss per share was 11 cents. This is a pretty significant loss per share, especially considering the number of shares they have outstanding, which has increased substantially. Scroll item 2. Management's discussion and analysis, Accession financial condition, and results of operational. Scroll in the management's discussion and analysis section, the company reiterates its strategy. They're all about robotics as a service, and they see it as key to overcoming labor shortages in the service industry. They are focused on long-term subscriptions and partnerships with large clients like car dealerships, and they're investing in research and development to improve their products. Scroll factors that may adversely affect our results. Counts of operation scrolls, they also highlight a lot of risks. Things like economic downturns, inflation, oil prices, and geopolitical instability and debilitability could all hurt their business. They also compete with other companies that have more resources. Basically, a lot of things beyond their control could impact their performance. When they talk about liquidity and capital resources, they're basically saying how much cash they have and how they plan to use it. With over $32 million in cash and cash equivalents at the end of June 2025, they seem to have enough to keep going for a while. They explicitly state that the cash from selling stock and warrants has significantly strengthened their balance sheet and given them financial flexibility. However, the cash used in operating activities for the 9 months of 2025 more than tripled compared to 2024. This tells us their core business operations are currently burning through a lot more cash. On the legal front, there's a civil action filed against them in New York for things like breach of contract and fraud. The plaintiff is seeking over $6,000. Richtech states they believe the claims are without merit and don't expect it to materially affect them. Of course, we'll have to keep an eye on that one. Finally, the exhibits list all the supporting documents for this report. It's a pretty standard list of agreements and certifications that back up the information provided. So, what's my take on Richtech Robotics' latest report? Well, on the one hand, they're making smart strategic moves. They're aggressively fundraising to fuel growth. They're expanding their physical and technological capabilities. And they're growing their international presence. The shift to a robots as a service model is a sound long-term strategy for generating predictable revenue. However, their operational losses are widening significantly, and their administrative costs are skyrocketing, while growth often comes with increased expenses, a more than threefold increase in G&A expenses. Year over year needs very careful management. They're essentially spending a lot more to make a bit less revenue in the short term. The key for Richtech will be to demonstrate that these investments in people and infrastructure will translate into profitable growth, and that their RaaS model can indeed become a stable revenue engine. The recent stock issuance helps them stay afloat, but they need to show a clear path to profitability to justify these high operating expenses. Alright, that's our breakdown of Richtech Robotics' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget you can join our Discord community for more in-depth discussions. The link is in the description. Thanks for watching. See you next time.